So again, this was the data processing system to be able to collect all the data and then generate the indexes. And then we back test. The key is to back test, right? So we were able to go back to 1994, which was great. Okay, so we had you got to have at least 10 years of back test data. I think with our new indexes, we're going to be able to go back to like 20 years, which the pension funds are going to love. Okay, because the more back test, the better. And then the cyclicality, you can see volatility in the indexes and cyclicality. So the cyclicality was very attractive for the pension funds, but the volatility was extremely attractive for the traders. So we were trying to meet the needs of both the traders for the derivative contracts to create liquidity in the contracts, and then to be able to actually track the overall commercial real estate cycle, okay, by geography and by property sector. So it met both the criteria. And then we had to analyze the indexes against economic factors. So, you know, it would be just like you creating an arbitrage pricing theory, an APT, using macro factors to try to forecast expected returns on stocks. So it's the same thing. We have the indexes, and then we overlaid industrial production and employment, because those are the major drivers of real estate performance. So we were trying to guide the market on how to forecast these indexes, and we found out that the indexes led the troughs and lagged the peaks. We proved that empirically. And then we looked at macro factors, ran correlations, regression and t-tests, again to help the market be able to forecast these indexes. And if you can forecast the direction of the indexes, and you know the index values are going to go up, then you're buying forwards and futures and calls on futures and writing puts on futures. If you know they're going down, then you're writing forwards, writing futures, writing calls on futures and buying puts on futures. So again, trying to help the market. Then we compared our indexes to other commercial real estate indexes, and we saw that there was a correlation, although we thought our indexes were better because they were transaction based, they were monthly, they were stratified weighted, and market cap weighted. Very different than the other indexes that were out there. So we felt pretty good about it. Once the indexes are constructed, then you can build the property derivatives market on these indexes. And the real estate market is just huge. So first of all, we said, well, you need these indexes and you need the derivatives because all institutional and retail investors, everybody's exposed to the real estate market, and there's no way to hedge off the market risk because there's no derivatives as tools for risk management, or to synthetically expose to the market by buying derivative contracts and leveraging your capital. I mean, I'd rather buy futures contracts or options on futures contracts with $100 million than buying $100 million worth of REIT securities or real estate. I can take my $100 million and I could probably leverage that into $10 billion worth of positions within the derivative contracts. And if I know what direction the prices are going to go, I'm going to make a heck of a lot of money just by taking the derivative positions because I can leverage the capital. We thought that the derivatives market was going to be the new product type that was going to revolutionize real estate and bring it into the modern capital markets era. And we looked at other types of real estate securities that had been developed and adopted over time. And again, these securities are just like S-curves within new technologies. We just thought it was going to be, this was going to be the next generation for the next 10 years of new products to modernize again the real estate market. We also were trying to figure out the adoption cycle for these derivatives, and this became this adoption curve. Basically, we were tying this to the notional values of the derivatives contracts, multiplying it by some market share that we would get, right, as revenue by developing these things, and that this became the pro forma, the projections for our pro formas for the next 5 to 10 years to forecast our revenues, our earnings, and then to be able to show on a present value basis that our company as the index providers was going to be a profitable unit for Schwab or a profitable unit for S&P. So we use the adoption cycle based on prior real estate security product adoption cycles to guide us in our revenue projections for our operating unit. If you look at property derivatives compared to other ways of exposing to real estate, it checked off a lot of the boxes. Liquidity, if the market was developed, ability to hedge, low transaction costs, property risk only, speed of execution. I mean, if we had a fully developed property derivatives market like we do with the S&P 500 mini, just imagine, the ability to hedge and go in and out, being able to make bets on commercial real estate that you can't do. You can do that in the stock and the bond market, but you can't do that with real estate. And then I do believe that if you built a trading strategy around the derivative contracts, and you really understood how to forecast these indexes and trade the derivatives correctly, you can create alpha. You'd be able to create alpha on the portfolios. There was many investors that would be interested in this product, particularly pension funds and hedge funds that wanted to participate in the market, particularly the institutional pension funds that had billions and trillions of dollars of real estate in their portfolios and in their exposures, but were completely unhedged. Okay, so imagine you own your CalPERS and you own $360 billion of commercial real estate completely unhedged. Now you can write the forward contracts and futures, buy the puts on the future. Now you can hedge off the real estate risk. And also international institutional investors. Institutional investors from foreign countries are limited in their ownership of real estate in the United States. But what they could do is they could buy the property derivative contracts, gain their exposure to commercial real estate in the United States synthetically through the derivative contracts based on the indexes as the basis. You had lenders that had huge pools of commercial mortgages sitting on their balance sheet. Commercial mortgage-backed security portfolios that were unhedged, and commercial mortgage-backed security portfolio managers and institutions that had the CMBS securities on their balance sheet that are sitting there unhedged. They can hedge off the interest rate risk, they can hedge off the credit risk, default risk, using credit default swaps and interest rate derivative contracts, but they can't hedge off the underlying real estate market risk because there's no property derivatives to do that. So the lenders were totally exposed to, and this would be a great product for them. Real estate portfolio managers, REITs and other private equity firms that are holding large portfolios of commercial real estate could now hedge off the market risk in real estate. And if they wanted to get into a market or get into a sector because they had an opinion that the market was going to either perform or underperform, they could buy the derivatives or write the derivatives and take a position. Or they could use the derivatives to hedge off the market risk embedded in their portfolios. Speculators could now trade these derivative contracts, creating liquidity, taking positions, and if you applied fundamental and technical securities analysis, these guys would be creating the market in these contracts and again providing liquidity, which is what you need. And then high net worth individuals with high exposures to commercial real estate would also be able to use the derivative contracts to hedge off their risk, or since these guys own real estate, they might actually, from their own operating data, be able to forecast where they think the market's going to go before the indexes respond. So from their portfolio, operating activity could actually show a slowdown or a ramp up, let's say in net operating income, which then would lead into pricing of commercial real estate up or down. They would be the first ones to see it at the operating level, then be able to predict the direction of the indexes, and then to be able to buy the derivative contracts to profit from the data and the analytics from their own portfolios. So the derivatives, these are financial innovations resulting in instrument from which value is derived from the value of the underlying real estate. Okay? The underlying assets can be commodity, share, index. This is just an introduction to derivatives. There are different types of derivative categories: options, futures, swap contracts. You can create structured products from the derivative contracts. If you go on and do your master's degree in finance, you're probably going to take a derivatives and an options class. You might take a financial engineering class. You might take a derivatives class, maybe a financial institutions class, where you would learn about how you create these structured products and these synthetic portfolios of derivative contracts. So I can create synthetic portfolios by taking futures, option, forward contracts and putting them together as a synthetic portfolio. Index-linked notes. We were talking to Barclays, which is now BlackRock, about creating index-linked notes based on our indexes, so that the notes would pay out the return of the index to the investors. And I thought that this would have been a brilliant product that would have been adopted by a lot of investors, because the correlation between the returns on these real estate index-linked notes, the correlations and the returns on these, since it's based on real estate, have low, no, and negative correlation with stocks and bonds. So if you stick real estate property index-linked notes into your stock bond portfolio, it's going to blow out the efficient frontier. Probably lower the expected return, but lower the portfolio risk even more and raise the risk-adjusted rates of return, which is the goal. You have exchange-traded funds that we could have created, which are actually we're creating one right now, and then up-down securities. So if the index goes up, then the price of the ETF would go up X times, or down X times. So they're X ETF, or X index products. You could use the derivatives for risk management, hedging, going short, your portfolio exposure. You can use them for diversification purposes. The one thing I liked the most was you could use them for cash management purposes. Let's say I'm a pension fund, I need to invest $5 billion, in commercial real estate, recommended by the consultant and the advisor. It's going to take me 3 years to build a portfolio of office properties of that size. If this market was developed, I could take the $5 billion and basically buy a 5-year forward contract, or basically buy 5 one-year forward contracts, taking advantage of being able to place the capital very quickly into these forward contracts, and then liquidate the forward contracts or let them come due. And when the money comes due, I've already had the properties teed up, so that once I got the money from my derivative contracts, I buy the properties. Or I liquidate and sell the forward contract, get the liquidity, and then place it in the properties once the properties of the portfolios come available. I thought that would have been, it would have revolutionized the industry, doing it that way. Also, banks could have calculated the value at risk of holding these commercial mortgages on their balance sheet. Once they figure out the value at risk within the portfolio, they could then figure out how many forward contracts or futures contracts or option contracts they would need to buy to hedge off the value at risk embedded in their portfolios. And then the swap contracts. Here's an example of a swap contract. So we would take the total return on the index, multiply it by the notional value. So this would be party A, party B. So party A would swap. They would pay the return on the index times the notional value would be what they paid. And then party B would pay LIBOR plus some spread. So they're swapping, basically fixed for floating. We could also create swap contracts. Let's say on party A and I'm overexposed to retail, and party B is overexposed to office. So I would basically pay the retail to the office overexposed, and he would pay me the office return. So I'm lowering my overexposure to retail. He's lowering the overexposure to office through the swap contract. Okay, that would have been another great product to create from this. And then the standardized contracts on the Chicago Mercantile Exchange. The contract is based on value of $250. These are all the standard contracts on the CME. So that's the contract multiplier times the value of the index. So the contract value is the contract multiplier times the index value. So 250 times 150 was the index value. So one contract would cost $37,500. And then you multiply that by 100 or 1,000 contracts, whatever the exposure is, whatever the hedge is. And then minimum tick fluctuations are 20 points or $50. So that's the tick movements. And they're traded for cash settlement on a quarterly basis. So just like any other, you could do option contracts, you could do futures contracts, you could do options on futures. So there's all kinds of other types of contracts that the CME could create out of these things if they were invented. And then lastly, just overall strategies. Risk management strategies, you can increase and decrease your exposure to real estate by swapping on the total appreciation between the two. Portfolio management tool, tactical adjustments. Let's say I'm over or underweighted in a sector or geography. I can tactically adjust by writing or buying the derivatives contracts by property type or region, and I can even hedge off. Once I got the return locked in on the index, I can lock in my return and write the forwards and the futures contracts and lock in that value, which was extremely important. And then speculation. We felt that there was a lot of interest in these property derivatives on the international basis. So if you were doing a global portfolio of commercial real estate and you needed a US exposure, but you couldn't buy properties in the US, you could go along the property derivative contracts to get your exposure. You could take a long position with committed capital until the properties became available, which I just talked about. And you could do a capital value swap to enhance appreciation return over certain periods. So there's a lot of flexibility that these derivative contracts could have provided our clients. So the overall goal of the research was to lay out a comprehensive modern institutional real estate portfolio management program based on modern and postmodern real estate portfolio theory and applications, basically just taking from the fixed income and the equity market, all the theory, all the applications, and bringing it over into real estate and then modernizing it and modernizing the capital markets. But unfortunately, 2009, 10, 11 hit. The indexes were discontinued. Property derivatives never launched. There had been at least a couple times over the last 10 years to try to relaunch the property derivatives market. They've all failed currently. And from my discussion with my colleagues at the conference that I went to, we all pretty much agree that the property derivatives probably will not be developed in our lifetime, maybe in your lifetime. So we're probably going to go into a recession in the next year or two. They're not going to be developing new capital markets product in 2021, 22, 23. So it probably means either 25 to 30 would be the potential time to reintroduce these. And if it's not, we'll probably be in another recession in 31 to 33, and probably 2035 to 40 may be the next window to be able to develop these kind of products. I'll be dead by then. So, I won't be able to do it. Okay? Maybe if you're interested, you can do it, but it's a really hard